Welcome to The Explainer. Today, we're going to decode the master plan for making debt work for you, not against you. We're building a step-by-step playbook so you can navigate the whole world of loans with total confidence. So let's just dive right in. When you think about a loan, is it a ladder to your dreams or is it a trap? Every single loan decision you make falls into one of these two categories. And figuring out the difference, well, that's the absolute first step to getting financial control. And this really breaks it down, doesn't it? A good loan is an investment in your future. It pushes you forward, helping you build assets like a home, or maybe creating growth through education. A bad loan? Man, that's all about fulfilling some temporary want, and it comes at a very real cost, the cost of your future wealth. It's a difference between smart leverage and a heavy burden. Okay, so before we even get into the weeds with banks and interest rates, we need to stop. We need a filter. And the very first question, the most important one, is super simple. Should you even be taking this loan out in the first place? To get the right answer, every single time, we're going to use a simple but, trust me, powerful two-part test. First up, the affordability test, and then the purpose test. If you can nail these two, you are already way ahead of the game. All right, let's start with the hard numbers. And look, this is where you have to be brutally honest with yourself. Do you have a stable income? Do you have a backup fund that could cover your payments for a few months if something went wrong? And crucially, can you afford this payment without sacrificing your long-term goals, like saving and investing? If the answer isn't a confident yes to all three, then hey, maybe the timing just isn't right. Now, here's a really useful tool to actually put a number on this affordability thing. It's called the EMI to income ratio. Now, EMI is just your equated monthly installment, basically your fixed monthly loan payment. So this ratio is just the percentage of your monthly income that's already going towards paying off all your existing loans. You can really think of it as your financial breathing room. And this chart here just lays it all out. These are the zones. If your total loan payments are less than 30% of your income, you're in the green, the safe zone. Nice. Now, if you're creeping up between 30 and 50%, that's the caution zone. You got to be careful. But anything over 50%, that's the danger zone. That's a huge red flag, not just for lenders, but for your own budget and, honestly, your own peace of mind. Okay, so you can afford it. But now for part two, the why. This is the purpose test. Ask yourself, is this for a genuine need or just an impulsive want? Is it going to give you stability or create growth? And here's the real gut check. When you factor in all the interest you'll pay, is what you're getting truly worth more than the total amount you'll end up repaying? Because if it's for a want, and the answer to that last question is no, well, that's a classic debt trap right there. All right, so you've done the hard work, you've run the tests, and you've decided this loan is a smart move. Awesome. Now comes stage two, getting the bank to see things your way. You have to remember, lenders are looking at you through a very specific lens. They're really just trying to answer one simple question. If we lend this person money, are we going to get it back? And to figure that out, they dig into these 5 key things, everything from your credit score to how stable your job is. And when it comes to those factors, this number, 750 plus, this is pretty much the golden ticket. A credit score over 750 tells the bank you're a low-risk bet. And what does that mean for you? It means faster approvals and, this is the big one, lower interest rates. Seriously, getting your score up here can literally save you thousands of dollars over the life of a loan. Okay, so let's get into the core strategy. You've passed your own tests, your financial profile is looking solid, but here's the thing, getting a loan isn't a passive activity. It's not about just taking the first offer that comes your way. It's about having a plan to find the absolute best deal out there. And this right here, this is the mindset you need. Getting a loan is a negotiation, not a request. You're not begging for money. You are a valuable customer, and these banks, they are competing for your business. Just remembering that, it completely shifts the power dynamic. So here's the playbook, the 6 steps. You got to do them in order. First, figure out the right kind of loan. Then do your homework. See what the standard rates are out there. Then go to your primary bank and get a quote. After that, take that quote and shop it around to other banks. And please, whatever you do, do not skip step 5, negotiate. When banks know you have other offers on the table, you'll be amazed at how much better their deal can get. Boom, you did it. You negotiated and you secured the best loan possible. That's a huge win. But the playbook isn't over yet. The final chapter is all about how to pay that debt off as fast as humanly possible. When you think about paying off debt faster, it really all boils down to 2 main strategies.
You can either attack the cost of the debt, that's lowering your interest rate, or you can attack the lifespan of the debt, that means increasing your payments. And the best part? You don't have to choose. You can, and probably should, do both.
So, how do you lower your interest? Well, here are 3 killer tactics. You can do a loan transfer, basically move your loan to a different bank for a better rate. You can even just call your current bank and ask for a reduction. Hey, it's worth a shot. But the really powerful one is what we call debt rebalancing. That's when you take out a new, cheaper loan specifically to wipe out your old expensive debts, like those nasty credit card balances. And just look at this example to see how insane the difference can be. Imagine you've got credit card debt at a crazy 36% interest. Ouch. But then you get a secured loan at, say, 10% and use it to pay off that credit card. The savings are huge. I mean, absolutely massive. All of a sudden, your monthly payment is actually crushing the principal debt instead of just feeding the interest beast. All right, now for strategy number 2, paying more. And the key word here is consistency. Whenever you get extra cash, a bonus, a side hustle payout, anything, throw it at the loan as a prepayment. But you know what? Even just paying a little bit extra on top of your minimum payment every single month, it adds up. That small effort compounds over time and can shave months, sometimes even years, off your loan. So what's the big takeaway here? It's that you are no longer a passive player in this game. You're not just waiting for the bill to show up every month. You now have a proactive playbook, a real framework you can use for every single part of the process, from deciding if you should borrow in the first place, all the way to that final glorious payment. You are in control. So, there you have it. The knowledge is yours now. This playbook gives you the power to turn debt from a burden, from a source of stress, into a strategic tool you can use to build the future you want. So the only question left is, what's your first move?